Hey everybody, welcome back to another episode of The Agent's Edge. My name is Ryan Palomini. Today we're going to talk about what RMDs are and why you need to pay attention to them. Now listen, when I first started in the annuity space, I was trying to figure out what the heck an annuity was, let alone tax planning, things of that nature. But as I've evolved and as we've kind of grown as a firm, being a tax-first firm, what I mean by that is every single plan we build is built on the foundation of taxes. And one of the reasons why we have the ability to work with such high net worth individuals now, and I'm talking about multi-million-dollar clients, I'm not talking about like $200,000, 300,000, I'm talking about multi-million-dollar clients, is because we take the tax-first approach. And I'm going to give you a secret that no one talks about in our industry. It is required minimum distributions. I know that because I compete with every one of you, and I compete with all the financial advisors, and it's the easiest way to create space between me and the competition by talking about things no one else is talking about. Why? Because for most people, a required minimum distribution is so far into the future that people don't even think about them. But the problem is, at our firm, we call it being proactive versus reactive. You can steal that from me, that's okay. Proactive versus reactive. What that means is being proactive is talking about things that no one else is going to talk about and planning for them now, even though it may not be here for 15 years. What do I mean by that? What is a required minimum distribution, or RMDs? An RMD is when the IRS tells you based on a certain age. So for most people, it's going to be 73 or 75 at this point based on the year they were born. Now, what the IRS does is they look at all of your qualified assets, and qualified money is things like 401ks, traditional IRAs, traditional 403bs, traditional 457s, on and on, and traditional TSPs. Anything that's a traditional IRA classification, pre-tax money, meaning it has not yet been taxed, is going to fall under the required minimum distribution. So once again, a required minimum distribution is when the IRS looks at all your traditional assets, they add it all up, and they tell you how much you need to be taking out. Because why? They want their tax dollars. So if I've got someone that's got $1 million, and this is roughly, don't take this, you go use an RMD calculator, it's going to be roughly about 40,000, give or take, plus or minus, depending on the age, plus minus, is what they're going to be forced to take out, even if they don't need the money. Now, think about for a second all the ways that can affect your client. Well, let's say that what if this client has $1 million and they have good income, they have, they only need $10,000 a year, right? So they've got their pension, they have Social Security, and they're taking $10K a year from this million. Number one, they're never going to run out of money because, for the love of God, $10,000 of $1 million a year, they're never going to run out of money. The other issue is this million is going to keep growing and growing if they're only taking $10,000 a year out, right? So that makes the RMD a bigger problem because the higher this million goes, the bigger this number is going to be. So again, think about a situation where your client needs $10,000 a year, and then all of a sudden the IRS forces them to take 40. That's $30,000 a year, 30 grand a year more now that they're going to be forced to take and pay taxes on. Just take a moment. If you know nothing about annuities or taxes, that's fine. Think logically for a second. What would that extra $30,000 a year in somebody's income potentially do to their tax bracket? What if this person right here is humming along in a 12% federal tax bracket, but they're kind of on the edge because at 12% you got a decent amount of income that you can make before you go to a 22. Okay, what if this 30,000 extra that they are forced to take is the difference between being in a 12 and being in a 22% tax bracket? Could you see why some people may be concerned with that? Because the problem is, if you are not proactive and you are reactive, you're not going to have the time to fix this. Because if you come to me at age 70 and your RMDs are 73, I got 3 years to come up with a strategy to reduce those RMDs. Now, I'm not going to get into that now. That's part of the academy that we built. It's in there. That's a very long conversation. But think about for a second, what could you do to help? I'm going to give you 2 strategies that you can use. Very simply put. Number 1, Roth conversions. Now, this Roth conversion is probably going to scare the hell out of some of you. Because if you don't know tax planning, that could be a scary thing. Okay? So what I would do if you're going to talk about Roth conversions, number 1, you got to understand how they work. Number 2, partner with somebody that understands it. Number 3, have a good CPA that's on your team. Because this is where things can go wrong. But if this person that has $1 million is 60 years old and their RMD is not until 75, they have 15 years before they have to worry about RMDs. Now, some people go, well, then I'm not going to worry about it till later. No. The younger, the better, because that means you have 15 years of doing things like Roth conversion. So if you've got $1 million you have to convert to a Roth, you don't have to do it all in 5 years. You have 15 years to do that, which means that you can convert and keep their tax bracket in the same or in that same 12% tax bracket. But what do you do for them long term? You allow them, we know what the taxes are going to be 15 years from now, right? But we're being proactive. So you can allow them to eliminate that required minimum distribution, or at least lower it or cut it in half. But by doing Roth conversions allows your client to minimize the RMDs, because Roth accounts are not subject to RMDs. Now, I'm talking about 2024 here, right? So disclaimer, things could change. So always know the tax laws and the rules around it. But as of right now, that's not the case. So that's number 1. Number 2, how else can you reduce somebody's RMDs? Well, you could use an income annuity to do it. Well, how would you do that? By putting a certain amount of this million into an income annuity, turning the income on, and letting that income start pass to them and giving them some income. That $10,000 they need anyways, great, turn it into a revenue stream for them, because in an income annuity, most of the time, when you turn the income on, the annuity is going to run out of money at a certain point. Usually break even's like, 18 to 20 years, give or take. But if you took 400,000 of the million, put it into an income annuity, and by 75 years old, they're still receiving that income for life. They will always receive that income forever, but their account balance may be 0 at that time. But what did that do? That eliminated 400,000 out of the million that's going to be looked at for RMD purposes. So you've eliminated a portion of what their RMD issues are going to be. But you go, Ryan, they still have 600 grand, and it may still grow. You're right. That's why sometimes you need a combination strategy of the annuity, of Roth conversions. This is more high-level stuff I'm talking about. But I need you to understand the basics, because your job is just to create space. It's to create space between you and the competition. Let me ask you, Mr. So-and-so, when was the last time your financial advisor went through and built out an RMD strategy? Or even better, what is your financial advisor's strategy for reducing your RMDs to 75? You get a deer in the headlight look, like, what are you talking about? No, it's a legitimate question. I need an answer to it, right? Because, we haven't talked about that. Okay, do you understand what happens if you don't? I'm telling you, of $1 million at 60. Do you understand what the compounding of $1 million over the next 15 years? That's going to be $2.2 or $2.5 million, which means this RMD is now 80 grand. What is your advisor's strategy for eliminating that problem from happening? See, simple stuff. You don't have to know all tax laws, tax rules. You just need to know how to have this conversation, because these type of conversations is what's going to separate you from everybody else. Listen, I hope this was helpful for you. RMDs, required minimum distributions, how to use them, what they are, and a couple simple strategies for eliminating them. I hope it's been helpful for you. Listen, drop some comments below. Let me know if this was helpful. Hit that subscribe button. Look forward to seeing you on the next episode.